Hello. We're talking about transactions and how they impact financial analysis, specifically ratios. And we're looking at ratios like the current ratio and working capital, which have to do with liquidity, the solvency ratio, debt to equity, and then profitability, which has to do with the net income, the income statement, and the earnings per share. So now we're going to take a look at some long-term liabilities. Specifically, we're going to borrow on a long-term note payable, meaning that we are the debtor and we're going into debt and we're borrowing money, which means our cash is going to go up, but so is our long-term liability called note payable. So if that's the case, I've got a current asset changing and a long-term liability changing, so that has no impact on the income statement. So no change in net income or earnings per share. The current ratio, since my cash is going up, that means the numerator is going up. So if the numerator goes up, that means the current ratio will increase. The working capital will increase. The debt to equity, let's see, I'm increasing a long-term liability, so my numerator's getting bigger, and if my numerator gets bigger, small number into bigger number, means this is going to increase as well. Well, what if we repay that note payable? And notice I'm keeping interest out of it right now because we'll handle what the impact of interest is down here. But we repaid the note payable, which means the long-term liability will decrease and your cash will decrease too. So if that's the case, again, it does not impact the income statement, so we don't have to worry about that. As far as the current ratio, because my cash is decreasing, my numerator is getting smaller, so that means my current ratio will go down. My working capital will get smaller because cash got smaller, and because I'm decreasing a long-term liability, my numerator here, total liabilities, are getting smaller, and if the numerator gets smaller, that means the debt to equity will decrease as well. So let's take a look at the interest. So we incurred and paid the interest on the note. And just to refresh your memory, that means that we debited interest expense and we credited cash because we incurred and paid it. So interest expense is an expense account, so my expenses are going up and my cash is going down, so my current assets are going down. So if that's the case, then I do impact my net income because expenses increased, so net income will decrease. Numerator here decreases, so earnings per share will decrease with the payment of interest. As far as the current ratio, notice that the cash is going down, so current assets are decreasing. Numerator's getting smaller. That means the current ratio gets smaller. Current assets minus current liabilities for working capital. Current assets are getting smaller. Current liabilities didn't change, so working capital shrinks. As far as debt to equity, we've got something going on with the expense, which means it impacts the net income. So the net income goes down, which means my stockholders' equity goes down. So my numerator, total liabilities, stays the same, but the denominator, stockholders' equity, is getting smaller. So that means debt to equity increases. So hopefully this helps you as far as the impact of changes in long-term liabilities and interest on your financial ratios. Thank you.